Hi guys, you are welcome to my YouTube channel. This is my first lesson on forex trading. I want you guys to subscribe to my channel and watch me as I demystify forex trading. Now, let's begin. What is forex trading? Forex trading is simply the buying and selling of currency in order to make a profit. Now, before you can be successful as a forex trader, you must have a comprehensive knowledge in the following areas. 1. Market structure. 2. Demand and supply zones. 3. Market imbalances. 4. Liquidity. And 5. Order block. If you can know these areas, then you will start trading as a professional forex trader. Today, I'm going to be treating market structure. So let's begin. What is market structure? Market structure is simply the movement of the market. That's the direction of the movement of the market. And market moves in 3 different directions: up, side, and down. So when market moves up, we call it an uptrend. And when it moves down, we call it a downtrend. And when it moves sideways, we call it a consolidation. Now, uptrend market and downtrend market are both called trendy markets. While this consolidation is called a consolidating or sideways market. Now, what do you do as a forex trader? Simple. When there's a trendy market, you trade. When there's a consolidating market, you don't trade. Unless you are a professional trader who is very, very vast in how the market works. But if you are a beginner and you've not been making profits in forex trading, I will advise you to always trade the trendy market. Now, let's show the actual movement of the market. In an uptrend, market moves like this, forming higher high, higher low, higher high, higher low. This is an uptrend market. An uptrend market forms successive higher high, higher high, higher high, lower high, lower high, lower high. Now let me explain this, the meaning of all these things to you. Now, in an uptrend market, all these structures are called high. because it is an uptrend market. But because this high is higher than this one, we call this one higher high. And because this one is lower than this, we call this one lower high. So in an uptrend market, we have higher high, lower high, higher high, lower high. That is an uptrend. But for a downtrend, it moves like this. Because it's a downtrend, these structures are all called low. But because this low is higher than this, we call this one higher low. While this one, we call this lower low. So a downtrend market forms higher low, lower low, higher low, lower low. While a consolidating market forms almost equal high and equal low, which we better refer to as resistance and support. Now, another thing you have to know about market structure is this. During the trading market, the market moves in two forms. During the trading market, it moves in two different forms. For example, if you are taking an uptrend, for example, market moves like this. This movement, we call this movement an impulsive movement. And the impulsive movement forms a higher high. While this other movement, we call it a corrective movement. And it forms a lower high. Impulsive movement, corrective movement. This one is a impulsive movement, and this one is a corrective movement. But I like to call this corrective movement a retracement. That is another name for a corrective movement. Now, I told you before, uptrend moves like this: higher high, lower high, higher high, lower high. Now, I just told you right now that this one is an impulsive movement, while this is a corrective movement or a retracement. You see, this an impulsive movement to form the next higher high, while this one is a corrective movement or a retracement to form the next lower high. Just like that. Impulsive, higher high, corrective, lower high. So it continues like that. Now, another thing you have to know is this. The market is not just this straightforward. Sometimes the corrective movement, the impulsive movement may not form higher high, Because before an impulsive movement forms a higher high, it must break a structure. What do we mean by break of structure? Break of structure is when this impulsive movement, move beyond the previous higher high. So at this point, where it moves beyond the previous higher high, we call that point break of a structure, or BOS. So in other words, every impulsive movement leads to break of structure. Every impulsive movement leads to break of structure. But sometimes, after a retracement, the impulsive movement is not strong enough to break the structure, maybe to just end at this point. Then it will retrace to form a lower high. So this very movement now is not regarded as an impulsive movement. Why? Because it refused to break this structure. So it is not an impulsive movement. So now, after the lower low, there's another movement, an impulsive movement. Maybe it is still not enough to break. It is not enough to break this structure before it forms the next lower low. Maybe the next impulsive movement will now move to break this structure. So this movement now qualifies as an impulsive movement. So here we have 1, 2, 3 impulsive movements. But we have 1, 2, 3, 4. 4 retracements. So sometimes the market can be like this. The importance of this impulsive movement is this. When the market is retracing, it tends to respect this lower low instead of this one. Because it is this impulsive movement that breaks this structure. So when it is retracing, it will most probably respect this lower low before another impulsive movement to form the next higher high. So this is the movement of market, and we call it market structure. On the other hand, during the downtrend, the downtrend forms lower low, lower high, lower low, lower high, lower low, lower high, lower low. This is lower low. This is lower high. Lower low. This is lower high. Now, this is an impulsive movement. This is the next impulsive movement. Why? It breaks this structure to form another lower low. Why these one are retracements? Retracement. Impulsive movement to form the next lower low, and a retracement to form the next lower high. So this is how the market moves, either uptrend or downtrend. Now, Another thing you have to know about market structure is this. A market can be going uptrend like this. You see, this is higher high, lower high, higher high, lower high, higher high, lower high. You see, this higher high is higher than this higher high. This one is higher than this. But for this lower high, this one is higher than this. So this one is lower than this. This one is lower than this. So after retracement, the next one is supposed to be lower than this. For the uptrend to continue. Sometimes this retracement will move beyond and break this structure. Now, at that point, this retracement has changed to an impulsive movement. Impulsive movement. Why? Because it has broken this structure. And this movement now invalidates this uptrend. It shows that the market is now going to move down because of this break of structure. Now, this kind of break of structure that changes an uptrend to a downtrend is what we call change of character. Change of character. Because the movement, this impulsive movement, is changing an uptrend to a downtrend. So at this point, the market will now continue down. What does the market do? It will now retrace. Because at this point now, this one is now lower low. It will now retrace to form a higher low. Then impulsive movement again to form lower low. Retracement to form higher low. Impulsive to form lower low. So this is how the market changes from an uptrend to a downtrend. Very, very important. Now, you can see, sometimes the market can also be like this. This is an uptrend. Higher high, higher low, higher high, higher low. Then instead of forming instead of this retracement, after retracement, instead of impulsive movement to form a higher high, the market will be like this. It will start consolidating. Maybe after consolidation, the next movement may just be an impulsive movement to break this structure here, to continue is the uptrend, to form higher high, then retracement, higher low, impulsive, higher high. So market can be like this. Uptrend, consolidation, then uptrend continuation. Then apart from that, a market can also be like this. Uptrend, consolidation, uptrend, consolidation, then downtrend. Now look at it. This is higher high, higher high. Then consolidation. There's an impulsive movement here to form the next higher high. Then retracement, lower high. Impulsive, higher high. Then retracement, lower high. Then this one now does not pass, for impulsive movement because this one did not break this structure to form the next higher high. Instead, the market started consolidating before we have a movement here that broke this internal structure to the downtrend. If we were to be like this, let's say this is higher high, lower high, another higher high, then lower high, another higher high, then there's maybe consolidation. So for this market to turn to downtrend, this structure must be broken, not this one. Because all this impossible movement has not broken this higher high. So this is the main trend. So for this trend to change to downtrend, this one must be broken. So now, maybe the next movement goes like this. This internal structure has been broken, but it has not changed the uptrend. This movement changes to downtrend only after this one. This one is broken. At this point, we say the market has changed direction to downtrend. So this impulsive movement invalidates this uptrend. Now the market will start going down. So this one is now lower low, higher low, lower low, higher low. Then the market continues like that. So once you know how this market moves, you can take informed decision as regards forex trading. Now, having know all these things, having know all these things, how do you now take your trade? How do you now take your trade during an uptrend or a downtrend? Let's say this is an uptrend. Good. There's an higher high here, lower high, higher high, lower high. So for the fact that this movement is an uptrend does not mean that you just take your trade anyhow at any point. For example, this movement breaks this structure and validates this uptrend. But just for the fact that this movement has validated this uptrend, they just take a trade buy. What will happen most of the time, 80% of the time, the market will reverse against you and take your stop loss, and you will lose the trade. So this is the error. This is the error so many traders made in forex. This is the error so many traders make in forex trading. Now, what do you now do? Even though this one is uptrend, what do you now do to take a buy trade? This is what you do. What do? You wait for the market to retrace, to make a corrective move. So after every impulsive move, 70% of the time, the market will make a corrective move. The market will retrace. It is only after retracement that you can now place your trade, buy trade, so that the next impulsive move will take you up. That is how to trade. That is how to trade. When it is an uptrend, you wait for a retracement before you take the trade up, before you follow the market up, because you don't predict the market, you only follow the market. You cannot predict the market because nobody can predict the market. So your job as a forex trader is to follow the market. If it's an uptrend, you wait for a retracement, then you follow it up. Now, the question you may want to ask me is this. How do I know that the retracement has come to an end? It is possible the market can retrace to this point and go up. The market can equally retrace to this point before going up. It can retrace here before going up. So now the problem now as a forex trader is, how do I know when the retracement has ended? Whether the retracement has ended, so that I can follow the trend up. This is how you know. Let me show you. So now, in this retracement movement, there are so many points inside. This retracement, it has so many points. In this retracement, there is demand and the supply zone. And a lot of traders are waiting for the market to retrace to this zone so they open a trade up. Also, in this retracement, there is market imbalance. And lots of traders are also watching, so that when the market retraces to that point of market imbalance, they will follow it up. Also, in this retracement, there is an order block. Order block or consolidation. Let us say order block and consolidation. So the traders are also watching this point. So if the market get there, they will follow it up. Also, there are some traders that are also watching indicator signals. We have different indicators, trend indicators like these moving averages and the Bollinger. We have oscillators. So a lot of traders, they are watching for their indicator to give them signal before they enter and go up. So all these traders, once the market retraces to their point, they follow it up. They open a trade and follow it up. And all these traders, they are known as aggressive traders. Aggressive traders. I hope my spelling is correct. Aggressive. Because once the market gets to their point, during retracements, the market gets to the point they are watching, they will follow it up. So they are known as aggressive traders. So there are other traders. One market get to this point, they will now suggest those points to market structure test. I personally call it market structure test because there is market structure everywhere. For an uptrend, the market structure test is like this: lower low, lower high, lower low, lower high, lower low, then break construction. That is for an uptrend. Then for a downtrend, the market structure test is like this. So these traders, after the retracement to this point, and they subject those points to this market structure test, before they take their trade. Such traders they are known as conservative traders. You get it now. So the aggressive trader, once the market retreats to those points, they open trade. But for the conservative, once the market gets to those points, they subject those points to test. It is only after they test this market structure test before they can open a trend, and they are called conservative traders. So now, based on the entry position, using these things I just talked about, we have we have aggressive traders and conservative traders. Now, the question you may also want to ask me is this: how do conservative traders subject those points to test before they open a trade? I will show you how they do it. Let's use our example uptrend. Higher high, lower high, higher high, lower high, higher high, lower high. This is an uptrend. And uptrend, every impulsive movement leads to higher high. Then there's a retracement, impulsive movement. Now, let's say this is a retracement. No, this is a retracement of a truth. And let's say traders are watching these points. As I earlier said before, conservative traders, after the market have retraced to those points, they will subject those points to market structural test before they open a trade. How do they do it? They go back to lower time frame. This is what they do. Let's say this one is a 4 hours time frame, for example. A conservative trader that have been watching this retracement, we go to 15 minutes time frame. For example, it could be 30 minutes, it could be even 5 minutes, 15 minutes, that is anything that is less than 4 hours. They will go back to that place and suggest those points to that test before they can open a trade. Now, one thing you have to know is this: all these impulsive movements, they are not straightforward line. They are not straightforward. They are like this. This up, they are actually like this. So the down is like this. What is this thing not writing? Okay, let me just use this black. Then the next up could be something like this. Then the next down will be like this. So this is how the market actually moves, because there's a market structure in every movement of the market. So now this one is 4 hours. This is an impulsive movement. This is a retracement. So if you go to 15 minutes, this retracement you are seeing in 4 hours will be a downtrend. Even though in 4 hours we are in an uptrend, this very point that is retracing in 4 hours will be a downtrend. So now, what the conservative traders do is this: When they get to 15 minutes, they will allow the downtrend to play out. Forming lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. Now, there is supposed to be a retracement like this before the next lower low. Instead, this retracement changes to an impulsive movement and breaks this structure, thereby invalidating this downtrend. So, after the structural break, it shows that the market is going to be moving up. That is when the conservative trader will open a trade, because the 15 minutes have given them the signal to open. At that point, the 4 hour is also going up. So that is how conservative traders open trade. And because of that, they miss on trade. While these aggressive traders, they have more trading opportunity. So they have more trading opportunity, and they also have more losses. For this one, they have less trading opportunity and less losses, because they do what I call two-factor authentication before they can open their trade. So I believe that you understand everything I just explained. This is purely market structure. It is how market structure works. So there are some traders, because this one is 15 minutes now. If you still go low, this one you are seeing, this is impulsive retracement. If you go to 5 minutes, this retracement can be a trend. So conservative traders can also go to 5 minutes to further refine their entry points, so that they have high probability trades with a high risk to reward ratio. So that is how, as a forex trader, this is how you are supposed to be trading, whether you are a conservative trader or an aggressive trader. Once you have identified a trend, you wait for the market to retrace. Then you watch for those points that you want the market to retrace to and open your trade there. Or you can further subject those points to market structure test before opening a trade. So at this point, let us go to the main MT5 chart. That is the main chart now, the main market chart, so that you know how all these things play out. Now, this is a GBP USD on a 4 hours chart. On TradingView, it is also the same with MetaTrader 5. From here, you will see that this market is trading down. So there's a lower low, a retracement to form a higher low. So there's another movement to form a lower low. So there's a retracement. The next movement cannot form a lower low. It is not strong enough to form a lower low. So there's a retracement here. It is a retracement because it has not broken this structure. So there's another movement to form an equal low. Look at it here, equal low. From here, there's a very strong impulsive movement to form a higher high. And this signals the beginning of an uptrend. So there's a retracement, another higher high, retracement, higher high, retracement, higher high, retracement, and impulsive movement to form another higher high. From here, there's a strong impulsive movement down to break this structure to form a lower low. And this is the beginning of a downtrend. So there's a retracement here, another lower low, a retracement, lower low. Let me shift the chart so that you see what happens next. Look at it. We stop here, retracement, lower low, just like that in a downward trend, retracement, lower low, retracement, lower low, retracement here. There's, I think, an equal low or lower low, but from here, there's a strong push up, a strong impulse to form a higher high, which also signals the beginning of an uptrend. So from here, there's a retracement here. There's another impulse to form higher high, retracement. There's a very strong impulse here, higher high, retracement, higher high. Okay, let me still shift once more to see what happens next. So this is where we stop. Retracement, higher high, retracement, higher high. So there's a strong impulsive movement down, although it has not broken this structure. So it does not pass as an impulsive movement. So there's a retracement here to form an equal low. Here, there's another movement up that could not break this structure. Instead, it stops here. Now there's a movement down, an impulse down, that finally breaks this structure to form a lower low, which signals the beginning of a downtrend. So the cycle continues, retracement, lower low. So this is how market structure plays out in a chart. And this is a 4 hours chart. So if you go to 1 hour chart, daily chart, 15 minutes, 5 minutes, even 1 minute, you will see market structure playing out. Market structure is in every chart, but it is advisable for you to use a higher time frame like daily, 4 hours, and probably 1 hour to do your analysis before you start trading. So thank you very much. Please, I want you to subscribe to my channel. If you have not subscribed already, please just subscribe and kind of encourage me. And this is my first video, and I believe that my subsequent video will be better than this one. Please just subscribe to encourage me. And also click on the like button. Thank you very much, and see you in my next video.